For years, Canadians were told the same basic money advice. Buy a cheaper car, stop ordering delivery, make coffee at home, cancel one streaming service. And sure, that helps. But what happens when you do all of that and your bills still go up? You drive an older car, but your auto insurance renewal jumps. You move out of the big city, but your home insurance doubles. You avoid luxury spending, but somehow your paycheck still gets swallowed by bills you are legally or practically forced to pay. That is the new Canadian money leak. Not a fancy truck, not a daily latte, not a vacation. Insurance. And the frustrating part is this: insurance is supposed to protect you from financial disaster. But for a lot of Canadians, the premium itself is starting to feel like the disaster. Today, we are breaking down why car and home insurance keep getting more expensive in Canada, why your rate can rise even when you did nothing wrong, and what you should check before you blindly accept your next renewal. Because insurance may be necessary, but overpaying on autopilot is optional. Quick disclaimer: this video is for general education only. Insurance rules, pricing, and coverage vary by province, insurer, vehicle, home, driving history, and personal situation. Always compare your own policy, ask questions, and speak with a licensed insurance professional before making changes. Here is the first thing most people misunderstand about insurance. Your premium is personal, but it is not only about you. You might say, "I've never made a claim, I've never had an accident, I drive carefully. Why did my insurance go up?" That's a fair question, but insurers are not just pricing your behavior, they're pricing the risk pool you belong to. Your postal code, your vehicle, your age group, your claims history, your home type, your neighborhood, repair costs, theft rates, weather risk, lawsuits, replacement costs. So even if you personally did nothing wrong, the cost of everyone else's claims can still push your renewal higher. Statistics Canada reported that auto insurance claim ratios rose sharply after the pandemic period and remained elevated into 2024, affected by collisions, theft, repair costs, vehicle prices, and inflation. In plain English, the insurance companies are saying, "We are paying out more, so everybody in the pool has to pay more." That doesn't make the bill feel any better, but it does explain why your clean driving record does not always protect you from a higher renewal. And this is where Canadians get stuck. They think the renewal letter is a final verdict. It is not. It's an opening offer. Let's start with auto insurance, because this is where a lot of Canadians are getting absolutely smoked. One viewer commented that they are paying about $3,000 a year for their 21-year-old son to drive a 12-year-old SUV with basic coverage. And a lot of parents watching probably felt that in their wallet. Young drivers are expensive to insure because insurers see them as higher risk based on age, experience, and claims data. But that is only one piece of the puzzle. The bigger issue is that modern cars are no longer simple machines. A bumper used to be a bumper. Now a bumper might include parking sensors, radar, cameras, blind spot monitoring, wiring, calibration, and parts that may be back-ordered for weeks. So a small parking lot bump that once cost a few $100s can now turn into a multi-thousand-dollar repair. The Insurance Bureau of Canada lists several reasons auto premiums have increased, including inflation, supply chain issues, legal costs, regulatory pressure, and the increasing sophistication of newer vehicles. That means the car does not even have to be new for the system to become more expensive. Parts cost more, labor costs more, rental replacements cost more, the average claim costs more. And if theft is high for your model, that can be another hit. Even if your vehicle is sitting peacefully in the driveway, your insurer is asking a bigger question. How expensive would this be if something went wrong? That's the question behind the premium, not just, are you a good driver? Now let's talk about young drivers, because for many Canadian families, adding a teenager or young adult to the policy feels like adding a second mortgage, but with fewer bedrooms. You can do everything right. Buy a used car, choose basic coverage, avoid luxury vehicles, keep a clean record, and the quote can still look ridiculous. Why? Because insurance companies price risk, and young drivers usually have less driving history. Less history means less proof. Less proof means more risk. More risk means higher premiums. This is why a 12-year-old SUV can still cost thousands per year to insure. It is not only about the market value of the car, it is also about liability. If that driver causes damage or injury, the cost of the claim can be much larger than the value of the vehicle itself. That is why dropping collision coverage on an older car may lower the bill in some cases, but liability coverage still matters. Here's the part nobody explains clearly. The cheapest car to buy is not always the cheapest car to insure. Before buying a car for a young driver, check insurance quotes first, not after, before. Because a vehicle that looks affordable on AutoTrader can become expensive the moment you add the insurance premium. That $8,000 used SUV might not be an $8,000 decision. It might be an $8,000 vehicle plus $3,000 a year in insurance, plus gas, plus repairs, plus winter tires. In Canada, the real cost of a car is not the sticker price. It is the all-in monthly drain. Now, let's move from the driveway to the front door. Home insurance used to be one of those bills people barely thought about. You bought the house, you set up the policy, you renewed every year, done. But now, home insurance is turning into one of the most painful surprise costs in Canadian homeownership. And it is not just happening in Toronto or Vancouver. People are moving to smaller towns, buying older homes, trying to lower their cost of living, and then getting hit with higher property taxes, higher insurance, higher utilities, and higher repair costs. One commenter said their house insurance rose sharply over 3 years. Another said they moved to a cheaper town, but the savings disappeared after home insurance, property taxes, and auto insurance. That is a powerful phrase. Financial gridlock. You make the smart move, and the system still finds a way to raise the bill. So why is home insurance rising? A big reason is severe weather. The Insurance Bureau of Canada reported that severe weather-insured damage exceeded $2.4 billion in 2025, making it the 10th costliest year in record for severe weather-insured losses in Canada. That includes events like floods, storms, hail, wildfires, and other disasters that make rebuilding and repairing homes more expensive. And remember, your premium is not just about your house, it's about the insurer's estimate of future risk. If your area has more flood risk, wildfire risk, storm risk, sewer backup risk, or rising rebuild costs, your premium can climb, even if your house personally had no claim. This is the part that makes Canadians furious. You can be careful, you can maintain your home, you can never call the insurance company and still get a higher bill because the risk around you changed. Now, let's talk about the real villain of this video. Not insurance, the renewal trap. Most Canadians do not shop for insurance every year. They get the envelope or email, they see the premium, they complain for 6 minutes, then they renew. Why? Because switching insurance feels annoying. You have to compare quotes, answer questions, check deductibles, understand coverage, maybe call a broker, maybe read documents that appear to be written by a committee of exhausted lawyers. So we do what Canadians do best. We sigh politely and pay. But that politeness is expensive. The Financial Consumer Agency of Canada says home insurance premiums can vary from one company to another, and consumers should shop around, ask for quotes, and compare prices before choosing an insurer. FSRA in Ontario also says auto insurance premiums can differ by company, and factors like the deductible you choose can affect your premium. Translation: your renewal is not automatically the best deal. It is just the deal your current insurer is offering you. And if you never compare, you never know whether you are being rewarded for loyalty or quietly charged for inertia. Now, this is not one of those videos where I tell you to just stop buying things. You need insurance. If you drive, you need auto insurance. If you have a mortgage, your lender will almost certainly require home insurance. And even if you rent, tenant insurance can protect you from risks that could financially wipe you out. So the goal is not to be uninsured. The goal is to stop being passive. Here is the renewal checklist. First, check your deductible. A deductible is the amount you pay out of pocket before insurance pays the rest of an approved claim. A higher deductible can lower your premium, but only choose a deductible you could actually afford in an emergency. FSRA and FCAC both warn consumers to understand coverage and compare policy details, not just the cheapest price. Second, check optional coverage. On an older car, collision or comprehensive coverage may or may not still make sense depending on the vehicle's value, your savings, and your risk tolerance. But do not randomly cancel coverage because someone online said so. Ask, what would I receive if this car were written off? What is my deductible? What premium am I paying for this part of coverage? Could I replace the car without it? Fourth, check your listed drivers. If someone no longer drives your car, ask whether they still need to be listed. Fifth, check your annual kilometers. If you now work from home or drive less than before, ask whether that changes your rating. Fifth, check discounts, multi-policy discount, winter tire discount, good student discount, alumni or professional association discount, security system discount, sump pump or backwater valve discount, claims-free discount. Do not assume they added every discount automatically. Ask. Sixth, check before buying the car. This is huge. Before you buy a vehicle, get insurance quotes for that exact model. Not a similar model, that model. Because two vehicles with the same price can have very different insurance costs. Seventh, compare at renewal. Not every month, not obsessively, but at renewal, get a few quotes. Use a broker, direct insurers, or comparison tools. Just make sure you are comparing similar coverage, deductibles, liability limits, and optional protections. Because the cheapest policy is not always the best policy, but the lazy renewal is often not the best deal either. Insurance is not like coffee. You cannot just make it at home. It is not like streaming. You cannot just cancel it and move on. Insurance is one of those boring adult bills that sits underneath your entire financial life. You only notice it when it goes up, and you really notice it when something goes wrong. That is why the goal is not to hate insurance. The goal is to understand it. Because if you understand it, you can ask better questions. Why did my premium increase? Which part of the policy went up? Is this because of my record, my postal code, my vehicle, my home, or the market? What discounts am I missing? What coverage am I paying for that I no longer need? What coverage would be dangerous to remove? Can another insurer offer the same protection for less? That's the difference between being a passive consumer and being a strategic capital allocator. A passive consumer sees a renewal and pays it. A strategic capital allocator sees a renewal and investigates it. And in Canada right now, that difference can be worth hundreds or even thousands of dollars a year. So if your insurance bill keeps exploding, you are not imagining it. Auto repairs are more expensive, vehicles are more complex, weather losses are rising, claims are costing more, risk pools are changing, and yes, some companies may be counting on you being too busy, too tired, or too polite to shop around. But your renewal letter is not a life sentence. It is a reminder to check the math. Before your next renewal, look at your deductible, your optional coverage, your discounts, your kilometers, your listed drivers, your home protection, and at least a few competing quotes. Because insurance may be mandatory, but blind loyalty is not. And in a country where everything already costs too much, the last thing Canadians need is another bill quietly renewing higher while nobody asks questions. If this video helped, subscribe for more Canadian money breakdowns that actually explain where your paycheck is going. And comment below, which bill should we investigate next? Property tax, utilities, subscriptions, or bank fees?